there's something else that we definitely need to speak about today. This happened a couple hours ago. SEC response to meme stock mania coming next week, according to the SEC chairman, Gary Gensler. Agency to weigh shortening stock settlement time next week. Hey, that's good. Used to be 5, then it was 3, currently 2. The closer and closer we get to evening, instantaneous, like the shorter the settlement cycle, that's going to close the window where people like, they kind of use that as like the loophole, the window of settlement to do various things that, in my opinion, increase the fragility of the overall market. We'll get into that more in a second. SEC Chair Gary Gensler speaks to Bloomberg Television. If you haven't seen it yet, this is definitely worth a listen, and we're going to be going into it. We're going to be dissecting everything that you need to know. So let me put this up on the big screen. So here we have Gary Gensler speaking today, and this is very, very important for the stock market and particularly retail.
Talked a lot about things you'd like to get done, but there are quite a few things that we haven't seen yet. Let's start with crypto, because everyone loves to talk about crypto. You said you think a lot of these tokens really are securities. Are you seeing evidence actually there are things being done in this market that would be violations of the securities laws if the securities laws apply?
Well, David, I thank you for inviting me here, and you're right. We do have a broad agenda, and crypto is part of that agenda, but it's an agenda really to make the capital markets work better for the investing public and for the companies on the other side, to drive more efficiency in these markets. As to your question about crypto, the agency is really just looking out for investors, and many of these tokens, not trying to prejudge anyone, but many of these tokens have the attributes of securities. They're raising money from the public, and the public is anticipating profits based upon the efforts of others. And so we've brought a number of actions. We're trying to work with the various crypto platforms, the exchanges, the lending platforms to come in, get registered, find where we can to adjust our rule set to get the investor protection for the public.
As you say, you've encouraged the exchanges to come in and get.
Now, hang on one second. What we need to talk about this is, if you want to know more about the SEC and the historic law and like kind of what's going on with crypto, you need to look at some of the content from, you could just check out actually the interview with Professor Verrett. We had him on, and hey, he's a lawyer. He's been involved in this world on Capitol Hill. And what's nuts about this, like, and this is going to be a key takeaway from that interview, is are cryptos securities? And like, whatever, that's up to them to like really decipher. But what's wild about this is they are basically using, you're going to hear the term like Howey test, which is, it's very, very antiquated. So basically from like the 30s or 40s, we have laws that were based on rules that were even a couple decades before that. So we're basically using definitions and like legal definitions and the way to examine if something is or isn't a security from almost 100 years ago. That would be equivalent to what's going on right now with crypto. Like the best metaphor I could come up with is, and this is actually exactly how Professor Verrett explained it, was imagine if you had all of these rules based on like a horse and buggy, like a carriage. And then all of a sudden, hundreds of years later, we're now applying these like horse and carriage rules to a car, and we're like, well, hey, they both have 4 tires, they both have 4 wheels, so like that means that we can still use these rules. I mean, regardless if they decide certain ones are or aren't securities, the methodology that they're currently using to apply it to see if it is, and right now like the hot topic is like the XRP, the Ripple case, it's insane. It's absolutely wild. It's absolutely archaic. They need to make a new set of rules and regulations that properly is, I guess, descriptive of the current crypto landscape, because you can't use something based on rules from 100 years ago. That's insane.
Registered. At the same time, a lot of them have not, as far as I can tell. At what point do you have to force them?
Well, no, it's because, look, if you're a platform and you have 75 or 100 or sometimes 5,000 tokens on that platform, probabilities are that a number of them, and maybe many of them, are what's called a security. And it's Congress painted with a broad brush. And it comes down to this: are you raising money from the public, and the public's anticipating profits based on the efforts of others? And my predecessor, Chair Clayton, the agency that I'm honored to chair at this point in time, is going to try to pursue investor protection. And if that means bringing greater enforcement actions, we'll do that. But it would be better to have these platforms come in, work with us, and come under the securities laws.
Do you think you've done everything you can under the statutes as they exist now? Do you need legislation in order to really go after and really get registration from those exchanges?
I think that the laws are pretty clear as laid out in the 1930s, and we have an
he
ability.
admits that right there. Laws laid out in the 1930s. Those laws were the ones based on rules from decades before that. Is it appropriate that we're using those laws, which then created these, like those rules that then created these laws? He said it right there. I think it's time for some adjustments.
To work with these exchanges using various authorities to basically tailor some of these, because these crypto exchanges and lending platforms have operated differently than the traditional New York Stock Exchange. But would it be helpful to work with Congress on some things? I've said this in the past around some details around transfer agents and others. Yes, but unless Congress says otherwise, we have to ensure there's investor protection in this space. And we're going to work with the Commodity Futures Trading Commission, where there's some that are commodity tokens, because while many of these are securities, some may be under their remit. And we work together as two federal agencies.
Let me turn, Gary, if I could, to a second item on the agenda in no particular order here, and that is payment for order flow, something that you've come out against.
Oh, brother, it's about to go down.
August, you said you were considering actually banning it altogether. Where does that regulation stand? And at this point, do you still think that's possible to ban it altogether, or is it more likely we'll have full disclosure?
Well, again, what we're trying to do within our remit is help investors get a better deal on one side and companies raising money on the other side a better deal, and drive greater transparency and efficiency in the middle of the market. So in the equity markets right now, if you place a market order, a retail market order, 95% do not go to the lit exchanges, do not go to NASDAQ or New York Stock Exchange. They go to wholesalers, and they don't have order by order competition. And part of that is because of what you just said, payment for order flow, which is, yes, it's banned in the UK and in Canada and Australia. The European Union, through something called ESMA, is looking at that right now. And so I think it's natural that we look to say, how do we drive greater competition and efficiency of this market, and use the tools that Congress have given us?
But are you keeping...
How are we gonna... We just have to drive it. We just, sometimes you're on the right side of the road. Sometimes you're on the left side of the road. Sometimes you're on the right side of history. Sometimes you're on the wrong side of history. And the answer to that is you just gotta drive it right in the freaking middle. All right, we got to stop there. A couple important things. Yes, it does seem like Gary Gensler is against it. Right there, he was just citing it's banned in Australia, it's banned in the UK, it's banned in Canada. And previously, he was talking about how it does really increase the conflicts of interest. Let's see if he gets a little bit more into that. But isn't that wild that right there, we knew this. And this is what really blows my mind. 90 to 95% of retail traders are not getting to a lit exchange. That is crazy. We know in about 50 to 60 of all trades getting to a lit exchange. So you have 90 to 95 of retail that's going off exchange, which is inclusive of these internalizers such as Virtu, Citadel Securities, and also dark pools. But most of it is going to internalizers. A high majority of that is going to internalizers. So that's just retail itself. You count everyone, 50 to 60% is not making it. This situation, it's crazy. And this is from the previous New York Stock Exchange president, Stacey Cunningham. When you have that, it truly is hampering price discovery. So when you are given all of that information, especially for some of these people who've been this for a year now, nothing drives me more up the wall than people who are allegedly apes, but are currently trading on the likes of Robinhood, and now it's Webull. I'm telling you, folks, so many people who large followings, allegedly apes, all of their trades. Sometimes they brag about it and they're posting it on Twitter and no one questions them. And then other ones are just telling me in closed doors, yeah, like just bought on Webull. What are you doing? I don't get it. It's insane. That's exactly why I use a different one, a non-payment for order flow brokerage, because I want all of my orders to go to a lit exchange. You heard it right there. 90 to 95% are not hitting a lit exchange. They are off exchange trading, and most of the off exchange is going right to a retail wholesaler, a market internalizer, whatever you want to call it, but it's Citadel Securities and it's Virtu.
Open the possibility, the option at least, of banning it altogether? And if so, when will you make a decision whether you'll do that or not?
Well, it would be a decision for the 5-member commission. We would put it out to notice and comment so the public gets to weigh in. We benefit from the public's view, from the investor side, the issuer side. To basically, a lot of our market right now is dark. It's not in the lit markets, David. It's dark and going to wholesalers, and how we get more transparency and competition in the market. So each feature is on the table, whether it's something called the minimum increment or tick size, or the national best bid, best offer, and how the order routing works. And yes, that includes not just payment for order flow, but possibly what's called exchange rebates. So it all fits together, and we haven't served up a recommendation to the commission yet. And the commission, if they supported it, would put it out to public comment.
Do you have an estimate or a guess on when?
Before we get into the estimate, the guess, just a little bit more clarity. I know there might have been some cute confusion there of what he's talking about and how this relates to maybe some real world examples. The best example I could give you is what's going on in Canada right now. In Canada, if you're trading on one of their exchanges, they have a system that's referred to as trade at. It's like the trade at system. Basically, it has to get executed on a lit exchange unless they can find a material price improvement somewhere else. A very close example to that is what we have going on right now with the brokerage Public. On Public, 75% of the trades are going to the lit exchange. The only time it's not going to a lit exchange is when they legally have to give you a fill somewhere else, i.e. off exchange, because they found you a better price. That is something such Dave Lauer taught me about it. I hope to teach all of you about it, but it's called the trade at system. It hits the lit exchange, and the only time it's not going to get filled there is if there's a material price improvement elsewhere. So that's what he was talking about, kind of confusion of oh, well, you have this and the routing, this and that type of thing. And rebates is another kickback to get your trade somewhere else. Overall, I think, yeah, that makes sense. Everyone should start out at the lit exchange. And then I guess if the broker can find you a better price, I don't know, I'd have to find a little bit more of the specifics on it. But if you want to read a bit more, once again, look at the trade at methodology.
You might serve it up to the commission?
David, I learned long ago not to sort of do that. I have occasionally, and it's about trying to get the economics and the law and the policy right, get it in front of a commission. If so, get it out to the public. So I understand the question, but I'll beg off for a moment.
I learned long ago to expect that answer, but nonetheless to ask the question. You never know.
No, you're doing your job. I'm trying to do my job.
I might get an answer. A lot of us really focused a lot on the payment for overflow when we had the Robinhood situation with those meme stocks, which I think we just passed the 1-year anniversary of. At the time, I know this commission was looking into the possibility that there was some wrongdoing. Have you drawn a conclusion? The fact we haven't seen enforcement action, does that suggest that maybe there wasn't any wrongdoing?
Well, again, for the public, in the job I'm in, I'm also a chair of a commission and sometimes has to vote on these various enforcement actions. So I can't get into any one matter or prejudge anything. But there was 4 matters of policy, not enforcement, but policy that we noted, and the staff did a staff report. And one of them we're going to take up next week, actually, in an open commission meeting, is about the plumbing of the stock market, what's called clearing and settling, and how we can take some risk out of the system. And also last year, the retail public found that they were foreclosed from trading, that a number of brokerage apps said, nope, it was a fateful Friday. And they said you couldn't buy any more of this stock or that stock. So we're trying to address the plumbing and put a proposal out next week. We'll also, I think, hopefully be taking up what's called digital engagement practices, what some people call gamification, and what to do there. and as you've and I've been talking about, the actual market structure itself. So there's 3 or 4 projects that we have here, and next week we're going to put our first proposal, hopefully, in front of the public.
So very quickly on that, the one that I don't really care about is gamification. They're basically trying to hate on these apps because they have like superior user interface. In fact, I think other applications should take a page or 2 out of the playbook of Robinhood of how they pulled it off, because it is very good UI, very good UX. Okay, maybe they want to get a psychologist in there and say like, okay, is it prompting people to buy like more? I don't know about that. I think that's I've never seen like a confetti wheel go off or something. I'm like, I might as well buy 10x more. That was a really good like result. Like, I love this. I don't know if anyone's ever really thought that way. So in all of those, gamification is by far my least worry. I think one that's important, but I'm confident it's going to get changed, is the settlement cycle. Right now, we're on a 2-day settlement cycle, and that's what gets a little bit more difficult to track shorts. And it really does kind of change the risk of the overall system, because with 2-day settlement, that kind of changes how much collateral these brokerages have to have at the DTCC. And then that relates to the whole liquidity thing we were talking about Robinhood, which really prompted them to take away the buy button. And it's all because they have to have the money on like a net trades in the day instead of the gross. Well, if you have like a smaller settlement like window, like if you shorten that, you're going to be closer to like the gross amount of trading opposed to the net. And it can help. It's not perfect, but with shortening the window, that is a thing that many people, it's actually become bipartisan now, which is also why I'm confident that like we're going to probably do it. Really, in reality, the only people who are against like shortening the settlement cycle are brokers, because they're using that to loan out their extra money to get more payments. But anyway, that's a different story. We could talk about that later. But overall, I'm confident. It's really coming down to payment for order flow, to the extreme nature of off-exchange trading.
Subject to my commission's approvals.
A third item on the agenda you laid out has to do with climate and disclosure with respect to climate. My understanding is when Bloomberg...
All right. I'm not saying the climate's not important. I'm just saying that this has already been running for a little bit. So I just wanted to pause it here and kind of wrap up this. If you want to know more about the climate, make sure you're checking out this Bloomberg article. But what I wanted to tell you, and please, if there's any questions about payment for order flow or this off-exchange trading, or what's the difference between an ATS, a dark pool, and like this, I guess, internalization, the retail wholesaling, whatever you want to call it, how do all these venues work, blah, blah, blah. If you have any questions, please post them in a comment below. But overall, here's what you need to know. This guy, whoever the interviewer is, he used the word disclosure. Are you going to ban payment for order flow, or are you just going to increase disclosure? And Gary Gensler basically said, not only do I not have an answer, but I don't even know when I'm going to give you the answer that I'm not sure that I have at this moment in time. What I want to stress is increasing disclosure. That's like, I don't even know. It's like a fuck all result. It doesn't matter. We have enough of the higher level numbers. We know how many trades are not getting to a lit exchange. If you give me the specifics of like, okay, Citadel handled this one and Virtu handled this one and they got paid this much and they got paid that much, it doesn't help me just to know that data, because it's more of like, if you have a cancerous system, well, okay, and you already know it's bad, well, okay, knowing the specific details of it, like you just know you have a cancerous system. And yeah, maybe knowing some of the details can, I guess, help with the ailment. But in this scenario, we already know the results and we know how to fight it. You just get rid of the cancer. So with it, this concept of disclosures, you know what disclosures aren't going to do? If the public knows about it, disclosures are not going to help with the power concentration in the duopoly that is Citadel, that is Virtu. What am I talking about? When everything went haywire about a year ago now, Citadel was literally bragging. They're like, we are the only ones who continuously provided liquidity. We are going to pat ourselves on the back. We did so good. That is not good. Only one person continuously provided liquidity. To me, that's a pretty fragile system. So there's too much power concentration in too few of players. That's no bueno. That's not good. On top of it, it's not solving many, many other issues. Okay, so on top of it, like I said, we have 50 to 60% off exchange trading, and we know 90 to 95% of retail is all ending up on off exchange. So right there, you now have a new age of conflicts of interest. You're going to have someone like Robinhood, someone like Webull, who cares more about the money they're getting paid and not necessarily the quality of execution. In fact, Gary Gensler in May of 2021 said this himself. He said Robinhood explicitly went out of its way to accept higher payment for order flow in return for worse quality execution for its clients. And actually, that difference was so bad that it would have been net better for the clients to be on a commission-based brokerage. So from there, there's just a host of issues. What's another one? The spreads. Disclosures do not address that. With all this being taken into account, now on the markets, you have wider spreads. Price discovery, the fragility of the market, the list goes on, and just disclosing it, giving us more detailed information in no way fixes any of that. So if I wanted to wrap this part up, the best thing I would say is we've been at this for a year. Payment for order flow is not good for the system. It hampers price discovery, it increases the fragility, and it incentivizes conflicts of interest. That's your tagline right there. And my takeaway from it, especially out of these like quote unquote people who have a following, if you see someone using Robinhood, if you see someone using Webull, if you see someone using a payment for order flow brokerage, if they are pitching themselves as an ape, I would not trust them in the absolute slightest. It's simply been too long. We have too much time has passed. If you're following them for something else and they're not necessarily taking up the mantle to fight for market transparency and fairness, whatever, have at it. I don't care. But I'm telling you, if they're pitching themselves as an ape and they're on Webull, Robinhood, another payment for order flow brokerage, that is the biggest hypocrisy. That's crazy. That is insane. It needs to be stopped. They need to be called out. There is literally no room for it. Like that, it's the opposite of what this movement is. If you want more informed, like I guess, decisions and opinions on this, I'm telling you, follow Dave Lauer, check him out, see what he has to say, see some of those interviews. The guy is a wealth of information. He literally is an expert of what's going on right now. Very, very cool guy. And this is wild. So apparently we might be getting some sort of update next week. Obviously, fingers crossed. Hopefully it goes in our way, but time will tell.